Please, please, please do not start looking for properties as your first step. I've had a huge amount of requests to provide more content on the actual house buying process. That includes the mortgage application, the solicitor process, the credit scoring process, and the steps around buying a house, such as how to approach placing an offer. So put the kettle on and get ready for the complete first-time buyer beginner's guide to buying your first home in the 21st century. Let's go. So you're a first-time buyer and you haven't got a clue where to start, what all the different processes mean and how they tie in together. Well, that, my friend, is where your problem ends, as we're going to go through the entire process in 10 easy, actionable steps without the BS. Please, if you're new to the channel or you're a regular watcher, please do subscribe and save this video, as if you're a first-time buyer, it's the only video you will ever need. I've also broken it down into chapters so you can navigate through each step and easily find parts of the process when returning to the video. Be sure to save this to a playlist and please share it with other first-time buyers that you feel this may benefit. Action 1. So the very first action you need to take as a first-time buyer, and please do not skip this step, otherwise it will bite you later on, you need to obtain a multi-agency credit report. This is not a single credit report from Equifax or Experian. This is a credit report which provides all of your credit profiles on one report, hence multi-agency credit report. You have to see what is going on all of your credit files at once, because this will tell you straight away if you're going to be accepted for a mortgage or not when you get to the agreement in principle stage. It will also show you if there are any errors on your credit file which could result in your mortgage being declined. Why could this be? A multi-agency credit report will provide Experian, Equifax, TransUnion and Crediva credit files on one report. I know mortgage lenders who just use Experian, I know mortgage lenders who just use Equifax or TransUnion, and I know mortgage lenders who will use a combination of any or all of these credit agencies to credit score you. This means they could pull in your profile from Experian and Equifax at the same time, or Experian and TransUnion at the same time, or Equifax and TransUnion at the same time. I think you get the picture. Therefore, if you only check Experian but have errors unbeknown to you on your Equifax credit profile, and you use a mortgage lender that looks at Equifax, your mortgage may be declined, which could be a total surprise to you if your Experian credit profile looks good. There are even mortgage lenders that will use Experian to credit score you when you obtain an agreement in principle, and then switch to using TransUnion when you submit the full application once you have found a property. So you may think you are home and dry if your mortgage is agreed in principle, only to later find out that your mortgage is declined at the application stage because a problem occurs that is reflected on another credit profile and not the one that was used at the start of the process. I hope you can see how important it is to get this first step right. Please, please, please do not start looking for properties as your first step. If you are lucky, you will get away with it. A lot of you, this will cost you time, stress and money. Don't put yourself through it. Get yourself a multi-agency credit report today. We suggest checkmyfile. They are by far the easiest credit report on the eye, easiest to read and understand what is going on really, really quickly. The other single agency credit files really do look like the Matrix. I can't stand looking at them myself, and the other free ones you get are usually outdated and clunky to use. checkmyfile was made for first-time buyers looking to obtain a mortgage. You can download your report for free within the first 30 days. It is £14.99 per month thereafter, and you can cancel at any time. It's a no-brainer. The link is in the corner of the screen now, so feel free to pause the video, download your file, as the next steps are going to help you quickly establish if you are mortgage material. The link is also in the description below as download free checkmyfile report. Buying your first home is difficult enough, so please do yourself a favour and make this a priority. So what do we mean when a mortgage lender is going to assess your data? This is when a mortgage lender will do a credit score, usually at the stage of the agreement in principle, or sometimes when submitting a full mortgage application, or sometimes both. These are the three areas you need to check on once you have downloaded your checkmyfile credit report. Check 1. Go straight to the voters roll. Are you on the voters roll on Experian, Equifax and Transunion? Scroll down and check all the columns, and if you do not see your current address on any of the rows below, it means you are not on the voters roll with that provider. Get in touch with that provider and let them know your voters roll records is not showing, and they will correct this. I've left the contact links for the relevant credit agencies in the description below for convenience. They may ask you for evidence you are on the voters roll, which you would have received from the council, and you can easily re-request the information. By being on the voters roll, it makes it much easier for mortgage lenders to pull in your credit history, as your credit commitments are linked to your address. If the lenders cannot pull in your address, they cannot pull in your credit history. The voters roll is the simplest way for your credit profile to be assessed by mortgage lenders. Check 2. Do you see any of your credit commitments missing on one credit agency throughout your credit profile? This could mean that your credit commitments are not being registered correctly by the credit agency. Use the same step as above and the same links to contact the credit agency and confirm you have missing information, and they will contact you with the right steps to correct this. Check 3. Do you have any missed payments, defaults or even county court judgments that shouldn't be there? Maybe you forgot to change an address with the provider, and because you have never checked all of your credit agency reports at the same time, you are not aware of any issues. Any missed payments will show as a number 1, 2, 3, 4 or 5 to replicate the amount of missed payments. Once you miss 6 payments in a row, the next step will be a default. Please be aware that if you forgot to change your address, which resulted in some sort of adverse credit on your file, it's very unlikely you'll be able to get this removed, as it is your responsibility to change your address when you move. Just let it be a lesson. Always change your address when you move on the voters roll and with all your credit providers. You may find you have a small outstanding balance with someone. Just get the bill paid or the default or the county court judgment satisfied, even if you do not think it's your fault. Don't waste your time on trying to overturn £50 mobile phone bills or £100 utility bills, as the longer the dispute goes on, the more it harms your credit file and the more it harms your chances of obtaining a mortgage and being successful. Get it out the way, move on. That's the best thing you can do for your future mortgage self. Action 2. So once you have solved any issues on your credit file and feel you are what we like to call mortgage ready, the next step is to check that you have all of the relevant documents that you will need for a mortgage. Identification such as a passport or a full UK driving licence. No, you cannot use a provisional driving licence. Make sure neither have expired, that the address is correct and up to date, and that there are no spelling errors. If you do not have either, and you want to get a mortgage, then I suggest you get one. Address verification. You need to supply a utility bill within the last 3 months or a council tax bill for that year. You can use a bank statement within the last 3 months if you do not have utility bills. If you are living at home or in a house share, just be aware you cannot use a mobile phone bill. Proof of income. Your last 3 months pay slips or last 12 weeks if paid weekly, they must have your correct address on and your name spelt correctly as reflected on all of your other documents. It's also a really good idea to get together your last 2 years P60s, or at least your most recent. If you have just started work, then don't worry about a P60. 3 months salary credited bank statements. Your net pay needs to be reflected of your pay slips and have your correct address on, and not have any large regular expenses. £1,000 a month to Deliveroo is not going to be received too well by a mortgage lender. Proof of deposit. The best way to save for a deposit is by opening a separate savings account and paying your wages directly into the savings account. You may have some type of ISA as well as a savings account, which is completely normal. A gifted deposit is okay from a close family member. Just be aware some lenders do not allow gifted deposits from distant family members and others do not allow it at all. So just check the lender's criteria under gifted deposits on their website. The person making the gifted deposit will need to provide a letter signed confirming the money is not a loan, does not need repaying, and they have no interest in the property. I've put together a free first-time buyer starter pack which includes a documents download checklist, a gifted deposit template and an updated first-time buyer guide for 2022. Please do download this, it will provide you with huge value when preparing for your first home. Oh yeah, don't use crypto for your deposit, just don't. Action 3. So you've checked your credit file, we're looking good there. We now have all of the correct documents in place in the correct format. The next question that will start coming to your mind is how much can we borrow, what property prices will be in our range, and how do we work that out? Okay, so mortgage lenders used to have what's known as income multiples, where you would times your annual income by a number, deduct any commitments, and you are left with the mortgage amount you can borrow. Some lenders still use this strategy, but a lot now use an affordability model specific to their criteria. Some lenders lend more if your income is above a certain level or if you have worked in a specific industry. So it's not always simple to understand your borrowing potential. However, there is one common denominator between most of the lenders. They will all lend at least 4.5 times your income after deductions. So I would suggest two methods of working out your affordability. Method 1. Take any personal loan payments, hire purchase payments, car loans, sofa credit, any maintenance payments you may make, any childcare costs, any pension contributions you make, not your employer contribution, any student loan payments, 3% of your credit or store card balances, including buy now, pay later, and times that figure by 12. Then deduct that figure from your annual salary. Finally, times that figure by 4.5. This will give you your mortgage borrowing potential. You can then add your deposit, which is a minimum of 5% of the purchase price, onto this figure to obtain your property budget. If you can find properties within this budget by using 4.5 times your single or joint income, this will give you a greater chance of success because you will have most of the lenders to choose from, and when you do start borrowing more than 4.5 times your income, the risk to the lender will increase, therefore the underwriting process may be a bit stricter. Method 2. Go to some high street lenders' websites under Tools and use their residential affordability calculator. You can use lenders such as Halifax, Santander, Lloyds, Barclays, NatWest, Virgin and Nationwide. All brilliant lenders for first-time buyers, and just go through filling in your data such as your credit commitments and income and expenses. Make sure to be as accurate as you can, and this will then give you various borrowing figures dependent on your specific situation. You can then check who has the best rates, check their criteria, and start deciding who is best for you. You may find some of these lenders will also lend more than 4.5 times your income, so if you fill in the affordability calculation, some lenders may give you two borrowing figures, with the second being the higher figure if you qualify. Just as a reminder, you will likely need to choose a 5-year plus product to qualify for higher borrowing amounts. Action 4. So you should now have an understanding of the amount you can borrow and your property budget. The next step involved would be regarding the type of property and type of mortgage scheme that you are looking for. This can be broken down into 3 categories. Category 1, purchasing an existing property, i.e. not a new build, not using any schemes such as Help to Buy or shared ownership, and putting a minimum of a 5% deposit down. In this instance, you would therefore need a 95% mortgage. Most lenders will lend on standard property types, which is also known as brick and tile or bricks and mortar if you're buying a house, or a purpose-built flat if you're buying a flat. Anything outside of a standard property type may need a specialist lender. Category 2 would involve purchasing a new build property. Not all lenders will lend on new build properties, and the ones that do may require a bigger deposit, so just be sure to check. There is also sometimes a difference in the deposit required if you are buying a house or flat. Category 3 involves a government scheme. Government schemes can be broken down into the following 3 options. Option 1, Help to Buy. This is where you purchase a new build property under the Help to Buy equity loan scheme. You can obtain up to a 20% equity loan outside of London or 40% equity loan within London. Properties that are being sold under this scheme will have the Help to Buy logo and will be mentioned in the description when you look at properties online. I did do a full video on the latest Help to Buy equity loan scheme. I will leave it on the end card at the end of this video and also in the description below. There are pros and cons to this scheme. The advantages include a bigger deposit, therefore having access to more expensive properties, being able to access lower mortgage rates, having access to lenders if you have adverse credit, having enough deposit for a new build, and having no interest to pay for the first 5 years. The downsides include no structural works can be carried out to your property while you have the Help to Buy equity loan. You cannot own another property in your personal name, and you need to repay the percentage you borrowed back in any profits the property makes when you repay the Help to Buy equity loan. For example, if you borrow 20% equity loan, your property makes £100,000 before you pay the equity loan back. You would need to repay the equity loan plus 20% of the £100,000 profit, which would be an extra £20,000. In my experience, most people who opt for Help to Buy is because sometimes it is the only option to get onto the ladder, and without the equity loan they would not have enough deposit to buy a new build, as with Help to Buy you only need a 5% deposit. Also, please note you can use the Help to Buy ISA or the Lifetime ISA in conjunction with the Help to Buy equity loan, and you will not lose any bonuses that would have been paid. Option 2 is the shared ownership scheme. First-time buyers who often opt for shared ownership is to obtain access to a bigger property when compared to other options, or it could be the only option due to affordability, as buying a share can sometimes be within reach when compared to buying a property of equal value outright. Again, there are pros and cons. The main pro is that it enables you to get onto the property ladder and start creating a mortgage history, with the main downside being you have to rent the remaining share from a housing association who own the remainder of the property. I would say if shared ownership is your only option, then take it as a pathway onto the ladder and use it as a temporary solution. I also know plenty of shared ownership owners who have gone on to own these properties outright when they once started with a small share. When compared to renting, where you own 0% of the property, owning at least 25% is a better bet. Option 3 is the remaining government schemes. You have Forces Help to Buy if you're in the army, and plenty of local government grants specific to certain locations. You just need to check the details on your local council. There is also more schemes coming, such as the First Home Scheme, which has recently kicked off and provides a 30 to 50% discount on new build properties to local first-time buyers and key workers. It's at the early stages, so you may not see the properties in your area as yet, but that will start changing within the near future. Finally, we have the Affordable Homes Programme, which should be kicking off soon, which is a complete reform of shared ownership. You will be able to purchase shares starting at 10% with 1% increments, and maintenance costs will lie with the housing association. That's just a few of the changes that will be coming. Of course, when this goes live, we will produce a video, so keep your eyes and ears to the ground on this one. Action 5. So once you know which direction you're going in, the next step would be to obtain a mortgage quote. In the previous step, you would have discovered how much you can borrow with the main high street lenders. This should steer you towards which mortgage lender to use based on affordability. You may favour one lender over another if, for example, they lend you a bit more. However, if it is fairly similar, then just check the lender's rates to see who is best. If you are going for a standard property type, you're employed with no major complications, then most lenders will lend. If you have any complications, such as maybe you are buying a non-standard property type or you are a contractor, then just check the lender's criteria to make sure everything fits. When you contact the lender, they will of course go through it in more detail, so you should know if they are right for you. You may need to speak to a few lenders until you find the right fit. Action 6. Once you have identified your mortgage lender and obtained a quote, if everything looks okay, the next step would be to think about an agreement in principle. Now, there is an argument which states you shouldn't get an agreement in principle until you know the type of property you are buying, as you don't want to obtain multiple agreement in principles and have multiple credit scores. You also have estate agents that may not allow you to view a property without knowing an agreement in principle is in place. So this is what I would suggest to do to get the right balance. If you know you are going to buy a traditional brick and tile house or a purpose-built flat and your employment is quite straightforward, most lenders are going to have criteria that may suit your situation. In this instance, you can obtain a mortgage agreement in principle with the lender that matched your requirements at the affordability calculation stage. Most lenders will allow you to do this online, or if you prefer you can do it via video chat or go into the branch. The process will differ between lenders. Just be aware that if your circumstances change or if you end up viewing a property that is different to your initial idea, then always make sure the lender is still suitable for your requirements. This is really important. Every time you view a property, ask yourself, do I have the right lender, and recheck their criteria, or just give them a call and run it past them. Action 7, and not the first, is to start looking for properties. You are armed with your agreement in principle confirmation, which will put you in a strong position when viewing and offering on properties. You can see there is a lot of work involved before you get to this point. This is of course the most exciting part of the property process. So where and how do you look for properties? Use the following websites: Rightmove, Zoopla, On the Market, Prime Location and Boomin. Just remember to use their filters. For example, if you want to see the new builds, only on Rightmove, select filters and choose new build in the must have area, and you can also choose what not to show in the don't show area, such as retirement homes. You can also specify location, minimum beds, price and property types. A tip: if you are looking for shared ownership, then you need to look at the share you would want to buy and not the overall cost of the property. For example, if a shared ownership property is $400,000 but you are buying a 25% share, you need to look at properties for £100,000 as this is 25% of the value. You must also have the buying scheme selected in the must have sections of the filters. Don't rely solely on these property portals, also look at the estate agents' websites within the locations you are buying, as they may list properties that the portals do not include. This also goes for their social media accounts. You want to make sure you have all bases covered. But be sure to register with estate agents so they send their new listings to you as soon as they come available. You can bulk register with agents on portals like Rightmove rather than individually with each estate agent, which may save you a lot of time. Then start creating a list of your favourite properties you like. You can favourite them on the portals or apps, or just use good old pen and paper. It's really important to keep records so you can easily find the property and track its activity moving forwards. Once you have found the properties you like, you can request viewings on the portal or just call the estate agents. If you can, take someone with you who knows a bit about property. If this is not possible, make sure that you view the property at least twice. The property will always look a little bit different on the second viewing. The first viewing you will be looking using your heart, and the second viewing you will be using your head. Just remember this, as using your head will be best. Action 8 is placing an offer. The way you approach this strategy is really important. First thing I want to say is don't just start offering on multiple properties for the sake of it. So you think you have more of a chance of obtaining a property, and then when a better one comes along, offering on that one. Estate agents will look down on this type of approach, and it will put you right down in the pecking order when it comes to considering offers made on properties. So this is what you need to do using a 3-step offer strategy. But before you do this, you need some information. The information required can be broken down into 4 key questions. Key question 1: when was the property listed? Key question 2: has there been any price changes? Key question 3: are there any offers in on the property? Key question 4: what is the seller's position? Let's go through these questions and why it is really important to know. 1. When was the property listed? You will normally get one of 3 answers. The property has just recently been listed, the property has been relisted, or the property was listed anywhere from 3 to 12 months ago. If the property has just been listed, then there is likely going to be competition, and if it's a decent property well priced, it will likely be sold quite quickly. Therefore, you need to act quickly if you want to offer and be considered. If a property has been on for a few months, then you need to know why. Maybe the property was sold and the buyers couldn't get a mortgage, or they pulled out. In this instance, this is a reasonable explanation for why a property was listed originally 2 or 3 months ago and has recently been relisted. Be sure to cover this in detail with the estate agent, because what you don't want is that if it has been relisted because the buyer could not get a mortgage because there was a major problem. If the property has been on the market for 3 months or more and still not sold, then the likelihood there is either a problem with the property itself, the location, or maybe the property is missing some essential requirements such as parking, maybe it's on a main road, something is preventing it from selling. Be sure to find out what this is. Now, for some people this could be an opportunity. Maybe you don't need a drive. Maybe you don't have kids or pets, so a main road is not a problem. If you are confident that the problem is just down to the buyer's taste and not the property itself, then this could be a situation where you could get a bargain. However, if the property has suffered a major problem like flooding, then the estate agent should be able to let you know. There are so many variables to properties, so it's really important you find out as much information as possible and don't be led by your heart after one viewing. There are a lot of potential problems which could come out of the woodwork after you've moved in. Be sure to cover them off now rather than later. Okay, so once you've got all of the information about the property in the previous steps and you are happy to offer, I would suggest a 3-stage process. The idea of the 3-stage offering process is that your first offer should be lower than your third offer, and your third offer should be the maximum you can go to within your affordability. You don't want to place a maximum offer you can go to as your first offer, as this does not give you any more room to play with. Your first offer would be determined from the information you have received when asking the questions in the last step. If the property has just been listed and there are offers already in, then to be considered you are likely going to need to be making an offer which matches the best offer which is already in, or maybe even higher. The position you are in, especially as a first-time buyer, may have an advantage over a home mover who needs to sell a property or a buyer who does not have a mortgage pre-agreed. Even though an estate agent will not tell you the specific amount of the highest offer, they should be able to share whether offers are in below the asking price, at the asking price, or over the asking price. In a seller's market, where the amount of buyers exceeds the amount of properties for sale, you will likely find that the offers are in close to the asking price or maybe even above. In a buyer's market, where the amount of properties for sale exceeds the number of buyers, the ball is in the court of the buyer as you have so much more choice. In this instance, you are much more likely to obtain a discount, and offers will always likely go in below the asking price and finish below the asking price. The longer a property has been on the market for, the lower the first offer would be. Obviously, bear in mind that there is more chance of a problem with a property that has been on the market for a long time. But this is not always the case. It's impossible to approach every property in the same way, as every situation is unique. Make sure you're not missing out on a bargain. Question 2. Has there been any price changes? This information is key, as maybe the first price was too high, maybe there is a problem. Why has there been a price reduction? That is what you need to find out. Once you have this information, you may walk away from the situation, or it may enable you to use this as a bargaining tool. Question 3. Are there any offers on the property? This will give you an idea of the amount of interest in the property. If there are no offers on the property, then why not? Why are prospective buyers not placing offers after they have viewed the property? What's the problem? Is it overpriced? Is there an underlying problem? If there are offers in below the asking price, then you need to establish where to position your first offer, taking into account the maximum you can go to. There is no one answer for every situation. I get a lot of questions such as, should I go 10% below the asking price or 20% below if it's been on for a long time? There is no answer that will apply to every property. Just get the information in these 4 questions and then go with what you feel is appropriate for your needs. Always with a focus on what you can go to as a highest price, and then make your way towards this highest price in 3 steps. This avoids being pushed up early on within the negotiating process, and also gives you a chance of getting the price lower than the asking price. As if your first offer is reflective of your maximum budget, you have no chance of obtaining any discount at all. Key question 4. What is the seller's position? The estate agent will let you know if the sellers need to buy another property themselves, and if so, if they have found a property, and if not, where they are within the process. You may find the seller does not intend on buying another property, which is therefore an advantage, as if they do need to find another property, That will therefore be another stage in the process that needs to be completed before you receive the keys to your property. If you're in a situation where you need to move out quickly, then a large chain, which is where you have multiple buyers in the process that also need to find a property to buy, the likelihood is the whole process could take a lot longer. If you have a small chain, this transaction could go through a lot quicker, as your sellers may not need to find another property. Maybe they are moving abroad or going into rented accommodation. This would therefore work in your favour. If you find that your seller has not yet started the process of looking for properties, this would be a red flag to me, as you do not want to offer on a property where the sellers have just put their property up for sale to test the waters. Unfortunately, this does happen and you don't want your time wasted, so finding all of the answers to these key questions will help you decide whether you want to put an offer forward and whether the situation fits your needs. Once you've decided you are happy to move forward with an offer, then using all the information you have obtained, you should then be able to understand where to place your first offer, second offer, and third and final offer. When placing your third offer, be sure to place it as your third and final offer, as this clarifies you will not be putting any more offers in, and therefore they will not attempt to squeeze you for every last penny you may have. You may find that you have to go beyond your third and final offer by a small amount to make the deal happen. So maybe have a very small amount of wiggle room after your third and final offer has gone in, just in case. But if you do tie the property up on your second or third offer, then you will likely have a good deal and avoid getting pushed up early on in the process. Action 9. Once you have had an offer accepted, you want to be able to give the estate agents your solicitor details as quickly as possible. A property solicitor is also known as a conveyancer. Once you provide your solicitor details, the estate agent will remove the property from the market, and this will reduce the risk of a buyer outbidding you at the last moment. When obtaining a solicitor quote, it is very important that you obtain a solicitor that specialises in your property transaction. For example, if you are using Help to Buy or some type of ISA, and most importantly, that the solicitor is on the panel of the mortgage lender you are using. Don't just choose any solicitor based on the cheapest out there. A good solicitor is well worth the money, and trying to find the cheapest one possible could end up costing you much more. To obtain a free solicitor quote, just head over to mortgagechain.co.uk or use the link in the corner of the screen now, as we have provided you access to our solicitor portal. You can enter your details and the mortgage lender you are using, and whether you are using any schemes or ISAs, and you will be provided with a range of solicitor quotes from solicitors that specialise for first-time buyers. The solicitors, more importantly, will be on the panel of your chosen mortgage lender and will specialise in providing services that reflect your situation. Just follow the instructions on the website, and when you are ready, just fill in your details and instruct your solicitor. Once you instruct your solicitor, you will receive personal contact from myself or my team to clarify your situation and have your client care pack sent out by your chosen solicitors. We will be there throughout the process should you need any assistance. You do not need to use us for the mortgage to access this free service. We made it available after the amount of requests we received and mistakes first-time buyers make when instructing the wrong type of solicitor. On top of providing the best solicitors for first-time buyers, when you do instruct a solicitor via our portal, you will receive the second search promise, which means when you instruct any solicitor through our free solicitor quoting system, you receive a second search promise. This means if your current transaction fell through for reasons outside of your control after your searches have been carried out, you would get your next set of searches completely free of charge, value between £200 to £300. We have provided a leaflet with information in the description below called the second search promise. You are also guaranteed of no completion, no fee. That means if your transaction does not complete, you will not be liable for any further fees other than the search fees you have paid, which is usually around £300. Common question I often get asked is, what is the solicitor process? This can be broken down into 5 steps. Step 1. A solicitor will send out a client care pack. This will request personal information from you and your transaction, such as the property you are buying, the amount you are borrowing, and a request for documents such as your ID and proof of deposit. Sometimes you have the options of using an app to submit these details for convenience. Step 2. The solicitor will ask you for around £300 in order to start the process of ordering your searches. So what are searches? Property searches are carried out on every single home purchase. This includes local authority searches, which would search local registers for information such as listing buildings, building control history, planning control history, nearby road schemes and motorways, and if there are any contaminated land or radon gas nearby, which could be potentially harmful. This would also include a water drainage search, which confirms if the property is connected to a public sewer or septic tank. It would also confirm if the property is connected to a public or private water supply, and if the property is close to or affected by water mains or public sewers. An environmental search will be carried out by a specialist company that looks into the past land use in an area. They check to see whether contamination is there or if there is a risk of flooding, and that can include energy and infrastructure and ground stability. Finally, other additional searches may include mining searches, which will be dependent on the location you are buying. Step 3. Final documents and draft contracts. This is where you will be provided with the searches when they are back, any other relevant paperwork such as your mortgage offer, which we will cover off in the next action, and a draft copy of the contract you are to sign in readiness for exchanging contracts. You would then approve the contract once you have had a look through and are happy, and if you need any further information, your solicitor will raise inquiries on your behalf. You might want the guarantees to that PVC door or some type of certificate for an item within the property. Step 4. Deposit requested, contracts exchanged, and certificate of title submitted. Your solicitor will request your deposit ready for exchange of contracts. Once your deposit is received and there are no further outstanding inquiries, your solicitor will confirm exchange of contracts, which means all parties such as yourself and the sellers have signed the contract. Once this is done, your solicitor will then submit what is known as a COT, or Certificate of Title. This is a document confirming to the mortgage lender you would like to request the mortgage funds and confirmation of the transaction. On the basis the lender agrees that everything matches, they will ready the funds to send for completion. Normally there is around a week between exchange and completion. Most of the time a mortgage lender needs 5 clear days to send funds between exchange and completion. However, there are certain instances where they will make allowances for you to exchange and complete on the same day. This is known as a simultaneous exchange and completion. The difference between exchange and completion is that you just provide your deposit at the point of exchange, and in between exchange and completion you will pay any outstanding balances. Your solicitor will send you a final statement. On the 5th and final stage is completion. This is where your seller's solicitors will confirm they are in receipt of funds from your solicitor, which will be your mortgage balance and deposit, which will equal the price of the property you are buying. Once this is confirmed, the estate agent will release the keys. Action 10. The mortgage application process. Once you have instructed your solicitors, you will submit your mortgage application with the lender that you got your agreement in principle with. The mortgage lender will go through a fact-finding process with you and recommend the most suitable mortgage product to fit your needs. When submitting a mortgage application, the lender, as a requirement, will carry out a basic valuation. However, this is just for the purpose of the mortgage lender and will not provide you with any information or report in regards to the property itself. I would highly recommend obtaining a home buyer's report from a RICS qualified surveyor. This will provide you a much more detailed report with information on the structure of the property, the condition of the chimney and the chimney breasts. They will take specialist equipment inside to measure for dampness within the walls and floors. They will check any woodwork for rot or infestation, as well as providing as much history and information as possible on the heating systems, the electrics, the boilers, and a detailed report throughout the property. A home buyer's report can end up saving you thousands of pounds. The report will provide a scoring system, with number 1 being in good condition and number 4 being in poor condition and needing immediate attention. Any works that need to be carried out will be shown at the back of the report with estimates how much this work could cost. This would then put you in a position to negotiate more off the asking price. If you're buying an older property like a Victorian property or something which has had a large amount of work done, you may opt for a full structural survey which is more designed for this property type. I provide links to blank reports so you can see what they look like and information on the different surveys you can have. If you want to obtain a free quote for a home buyer's report or a full structural report using a RICS qualified surveying company, just head to mortgagechain.co.uk, select quote and then survey quote. You can input the property address and your details, obtain a quote and instruct your surveyor. We use this fantastic survey for our clients all the time, and this often uncovers problems that a basic valuation would not have seen. Please do obtain your free quote today. The link is also in the corner of the screen and in the description below. Your mortgage lender during the mortgage application process will request all of the documents we went through in the previous steps and will instruct a basic valuation on the property you are buying. On the basis that they are happy with all your documents and they reflect everything you put on the mortgage application, and on the basis the property you are buying values at the price you are buying it at, the mortgage lender will issue a mortgage offer. This is the legal document which states you have got the mortgage. Amazing news! This means the lender is happy to lend. They will send a copy of your mortgage offer to you and your solicitors. Once your solicitor has received a copy, they will send you a letter confirming if you need to sign the mortgage offer or not. This depends on the mortgage lender. You will also receive a mortgage deed, which you will need to sign, have witnessed and returned. Make sure you do not date the mortgage deed. Once you have done this, everything is in the hands of the solicitor. The mortgage side is done. You can refer back to the solicitor process to see where that ties in with your mortgage. It is worth noting that most mortgage lenders will provide a mortgage offer for 6 months. Occasionally, a lender will provide a mortgage offer for 3 months, so be sure to check how long your mortgage offer is valid for. If this expires, you may need to have what is known as a re-inspection, where the mortgage lender will check the property is still worth the amount you are buying it for. You may need to pay around £100 for this re-inspection. If you are buying a new build, the process often goes over 6 months. Some lenders will automatically renew the offer for another 6 months, and others will require up-to-date documents to check you still earn the same amount as when you applied for the original mortgage. If you're buying a shared ownership property, the housing association will be involved within this process, and therefore it could take a bit longer. On average, a property transaction within the UK takes between 3 to 4 months from start to finish. Occasionally everything can fly through within 5 to 6 weeks, but this is very rare. If I was you, I would allow around 4 months. Any time quicker is a bonus. Right, that's the end of today's video. I literally put everything into this video to try and give you an understanding of the whole process in much more detail. This was based on recent questions and answers provided on Instagram. Please do give me a follow at Alex Kerr Mortgage. If you would like a free chat to go through your options and to discuss any parts of the process within this video, just book a free no obligation chat by using the link below or in the corner of the screen now, or by clicking the mortgage chain logo on the end screen of this video. Today's question: were you aware of these processes when buying your first home? Let me know. Mortgage warning. Please note, we do need to let you know that your home may be repossessed if you do not keep up with repayments on your mortgage. So thanks for watching today's video. I hope it's provided you with some useful tips. Please check out the show notes for a recap with access to any links discussed today. Please do consider subscribing and ringing the bell to receive notifications on our latest videos. I've been Alex Kerr, providing the best tools and tips to first-time buyers. I'll see you in the next one.